I run sector investment managers, and among our investment products, we also manage a junior gold fund, which, as the name suggests, invests in junior gold and silver mining companies around the world. And the main approach is to invest in companies that have identified resources, because we believe in the value of resources in the ground in safe political territories. That is, we don't want to worry about someone directly or indirectly taking away our resources. So you can safely assume that I'm a believer in the value of gold and silver as stores of value and safe havens going forward. I'd like to concentrate on the recent developments in those metals and what is the possible outlook that could sort of re-rate our investments. So I'd like to point out that at the moment, perception is what can distort value in the short term. And we have seen it in the equity markets with the technology sector at huge valuations. We see it in the bond markets, extremely volatile, subject to the Fed and other central bankers' interest rate decisions. And gold has been subject to this lack of perception of value in recent years. I'd like to just tell you a little story about perception. So there are three young ladies who go out for a friendly drink. One is a redhead, one is a brunette, and one is a blonde. So they go into a bar, and after a while, they start chatting to the barman, who notices that they are wearing very expensive jewelry. So he asks them their opinion about precious metals. So the redhead says, "Oh, I love my gold jewelry. It has gone up so much in value over years that I could probably buy a very nice car now with it." The brunette turns around and says, "My jewelry is made out of palladium. And did you know that palladium has gone up in value much more than platinum, of which is a very similar metal? And I could probably buy 2 cars with my jewelry." And then the blonde says, "Well, I don't care very much about gold, platinum, or palladium. I just have 2 silicone bags, and you should see the cars outside my drive." So a few risk warnings about what you're hearing. Now, gold has been considered a safe haven and store of value since antiquity, and it does provide an insurance against unexpected developments. And it has proven its worth in recent crises, for example, in 2000 with the dot-com crash, and in 2007, 8, 9, I would say, with the financial crisis. We live in a very uncertain world. We have geopolitical crises rising around the world. In the Middle East, for example, we have a conflict between the West and Russia, with Russia's boisterous attitude and territorial claims. There are conflicts between China and Japan over territory, conflicts between North and South Korea, to name a few. So we live in a very unpredictable geopolitical landscape. Furthermore, we have the macroeconomic risks. Global debt to GDP is now well in excess of 320%. Any corporate entity with debt over 320% of its production would be extremely worried of a decline in its markets and a squeeze in its operating margins. So we could have, we have the proponents of the modern monetary theory who argue that it's okay to have huge debt levels in the world today because government can print money and governments are in control. Therefore, we can run this strategy forever. And then we have the more conservative Keynesian economists who argue that the global economy is not different to any corporation, and therefore we should be acutely concerned about the levels of this debt and how this might be paid off, especially if the world goes into a recessionary phase. Now, there are plenty of predictors at the moment that suggest that the global economy is slowing down. We have the trade wars between the West and China, for example, that could provide a major break to economic growth and could trigger a recession. And any recession would particularly affect the high growth economies in the world. It could affect emerging markets. It could even affect China, who have both accumulated huge amounts of debt, more than double the level that they were at before the financial crisis in 2007. So gold could be a good thing to have in a portfolio to provide some stability and some store of value in case of uncertainty and volatility. If you look at who is buying or who has been buying gold in recent years, you will notice that it has been primarily central banks. For example, and this chart at the bottom shows the percentage of reserves in each country that is held in gold. You can see that Russia has massively shifted its reserves into gold, obviously following the sanctions and the conflict with the West, as they are trying to avoid any dollar influence to their economy. And they have shifted their reserves from 3.5% in 2008 to over 18.5% today. That's a massive shift in favor of gold. China has shifted its reserves from approximately 0.5% in 2008 to 2.5% now. And that's the latest reported figures that we are not sure capture the most accurate data. India, another example, has shifted its reserves from 3.8% to double that, 6.2%. Turkey, another, from 0% in gold in 2008 to nearly 14% now. So there has been a massive buying wave by central bankers into gold bullion. And what does this tell us? That these people are not short-term traders. They are not going to sell because gold goes to $2,000. They keep it because they want to secure their reserves against the instability of the global currency systems. So we have a very strong tailwind in favor of gold. And we see it in the price action recently. Now, this chart is slightly out of date, ladies and gentlemen, because I prepared it on the 14th of June as I was writing up my notes. And you are probably aware that in the last few days, gold has broken above the 1,400 per ounce level in US dollars, which has been a key resistance point for over 6 years now. We have traded in an upwards trend, hitting higher lows, but always meeting that resistance level of about 1350, 1360, and dropping back again. Now, today we are well above that. The obvious assumption to make here is that if financial investors who prefer ETF exposure, ETF backed by bullion, to reposition their portfolios into some sort of a safe haven mode, if they start increasing their allocation to gold via ETFs, there will be less gold bullion available to deliver to those ETFs to back their investment requests. So therefore, a move into gold could be disproportionate when the financial investors decide to increase their allocation into gold. And we have to bear in mind that global allocations into gold at the moment is less than 1%. Now, what about silver as a safe haven? Many regard silver as a proxy for gold, but in fact, silver has many important industrial applications. So there is a very strong physical demand from the industry driving the demand for silver. And we see it in photovoltaics, we see it in most technology applications, iPhones, smartphones, tablets, computers, etc. But it does respond, if history is any guide, in a much more volatile fashion to movements in gold. So for example, you see in the aftermath of the financial crisis, silver initially lagged gold for a couple of years until some kind of a surge in demand by ETF buyers pushed its price very rapidly in a hockey stick style up to $50 an ounce. And since then, of course, gold started dropping after 2011 because investors became very comfortable with the idea of monetary easing and the global liquidity rise and the rise of the stock markets. So they abandoned the idea of holding gold in their portfolios. And silver, you can see, crashed much more disproportionately to gold, much more volatile. And it has since failed to keep up track with gold. Now, if we believe that we are now entering a new bull run for gold, well, its price is going to rise significantly higher, at some point silver is likely to catch up, and it will catch up with a vengeance. It will catch up much more quickly than gold. And at that stage, it might be worthwhile owning some silver in the ground. We spoke about platinum and palladium briefly in our story earlier. Palladium has been used as a substitute for platinum in catalytic converters recently, but most importantly, has been incorporated into many applications in electronic devices, and hence the demand for it has boomed in recent years. And you can see how it has massively outperformed platinum over the last 10 years or so. The problem with palladium is obviously that its supply is concentrated in less stable territories, if I should say, of South Africa and Russia. So effectively, it does make it a scarce commodity, and perhaps that is another factor that drives this price. So in short, if we think about the outlook for precious metals, what might be the winners and losers? We are in a very muddy macroeconomic picture. We cannot really see if there is a recession ahead of us, what are the forces driving such a recession, whether it's going to be the trade wars, whether it's going to be the debt levels, etc. However, gold is likely to remain a main safe haven for portfolio allocations for investors. So we believe that it's probably it has a fairly good outlook for a rising trend, particularly if we have any sort of financial crisis. Silver will respond to the gold bull market with a much more volatile fashion. So one has to be prepared to have extreme volatility in the market and the underlying equities. Ultimately, as I said, central banks have been storing away gold bullion, therefore there is less available to supply into a rise in demand for ETFs that need to back their assets with gold bullion. Palladium may remain strong because of its industrial applications, but it does feel a little bit overbought at this level. And platinum finally could be a cheap play and could stage a catch-up rally with the other precious metals. So with that, ladies and gentlemen, I would like to wish you happy investing. Thank you.